Hi friends, this is Rahul Jain, and in today's video we are going to discuss valuations of companies. Have you ever wondered why some companies generally trade at higher valuation than their sector? See the chart and you will notice that the pink line, which is the PE ratio of a stock X, has been higher than the nifty IT PE ratio in green line most of the times. This simply conveys that the stock X often enjoys higher valuations than the average valuation of companies that make up the IT sector. This brings me to an important concept of economic moat, a term coined by legendary Warren Buffett back in 1995. A moat is a deep, broad ditch dug around a castle historically to provide it with a preliminary line of defense. In business terms, it means if a company has a competitive advantage over its peers, the company is likely to generate better returns for its shareholders. And when a sufficiently large number of investors recognize a clear economic moat of a company, they are ready to pay a higher price than the actual worth or perceived worth by the broader market. So key takeaway so far is a company is likely to enjoy higher valuation if it has a competitive advantage or an economic moat. The next, even more important consideration investors evaluate about economic moat is how easily economic moat can be sustained for a long period of time. Longer it can be sustained, the higher the valuations are likely to be. Let's understand broad types of economic moats with examples. Number one, monopoly. Some companies can have monopoly-like dominance in their industries. For instance, some public sector undertakings have monopoly-like dominance in their respective industries, such as defense production. For example, IRFC, Indian Railways Finance Corporation Limited, is a PSU company that arranges finance for Indian Railways. So whenever Indian Railways need funds for railways development, the only company that is authorized to finance is IRFC. There is no competition here. Margins are predetermined. These types of businesses are called monopolies and have strong economic moat which may be sustainable in future. Number two, low cost advantage. Second type of economic moat is low cost advantage or comparative advantage. Many companies are able to offer products, services at a lower cost than their rivals. A good example will be the retail chain D-Mart. These companies transfer all or some of their cost savings to customers in the form of lower prices. Third, expertise-led moat. Third type of economic moat can be called expertise-led moat. When companies develop products, services that are unique and are extremely hard to copy, they build an economic moat. For example, a company X developed an infertility solution for women which is highly complex and hard to copy. A lot of companies which have developed patents in the defense sector will also fall into this category. Fourth, softer moats. Fourth type of economic moats are softer in nature. For example, a unique culture developed by a company, or for that matter, strong brand recall value like Nestlé's Maggi, or key management personnel, for example, Reliance's top management, that are hard to compete against. Fifth, new age business moats. Fifth type of economic moats are based on the recent developments in the data and technology. Companies like Google, who have access to a lot of consumer data, have developed a data-driven business moat. In the Indian context, companies like eMudra Limited, which have developed a cybersecurity solutions adopted by banks, have a technology-driven economic moat. You may have a natural question here: how can one identify stocks that have strong economic moats? Is there a framework? So there is no defined frameworks as such, but one can use a top-down approach in order to find companies with business moats as follows. Number one, first narrow down on a sector you want to find companies in. Number two, narrow down to those companies in the sector which have higher return on equity, ROE, in the last 2 to 3 years. Number three, study the business model of such companies using their website, annual reports, earnings presentations, and so on. Number four, try to find a unique value proposition in their business models and do a comparative study with their peers. You may be able to spot unique competitive advantage and may very well find economic moat. Number five, validate your understanding with industry experts or people who you know have been working in that sector for long enough. In summary, economic moats help stocks grow faster than their sector, and therefore, these stocks generally enjoy higher valuations. Finding and investing in stocks with economic moats can generate wealth for investors in the long term. I hope you found this video useful. I'll see you in my next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.